Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm very excited to be joined by Cathie Wood from ARK Invest. So I'm sure many of you are familiar with Cathie. She's really become a household name in the world of investing. She is the founder of ARK Invest, founder, CEO, and CIO of ARK Invest, an investment management firm focused solely on disruptive innovation that was founded back in 2014 and has truly flipped the sort of traditional investment management mindset on its head, I think. How active managers have typically behaved in the space. Her open approach to sharing her holdings, sharing her research is truly unique in the marketplace. And today, but a couple of weeks ago, we're celebrating our 1-year anniversary of our partnership here at BMO ETFs with ARK. Last November, we listed 3 of ARK's mandates here in Canada: ARKK, the BMO ARK Innovation ETF, ARKW, the BMO ARK Next Generation Internet ETF, and ARKG, the BMO ARK Genomic Revolution ETF. So I can refer to them now just by their ticker now that I've said the full name because that's a mouthful. But we're very excited to have come up on our 1-year anniversary. These are the same mandates as the US listed ETFs, but they are available here in Canadian dollars for Canadian investors. Today, Cathie's going to walk us through ARK's research around disruptive innovation, including themes like artificial intelligence, genomics, robotics, and really take us through some of their groundbreaking research. So before we do get started, just a quick reminder that this video, we're not providing investment advice or investment recommendations. This is all for educational purposes only. So Cathie, welcome back to Market Insights. It's been almost a year since you've been on, so good to have you back.
Yeah, very exciting year, that's for sure. And I'm delighted to be back with you, Erin.
Since it has been a year of our partnership, I thought we could just look back sort of on a year-to-date basis over the past year. How have the portfolios been performing, and what can you point to as sort of the main drivers of some of these stronger returns we've seen as of late?
Sure. So the year-to-date returns are quite strong, except for the Multiomics or the ARKG. And I think healthcare broadly has been disappointing this year. In fact, it's negative. Healthcare is generally, I think, in the US, it's down mid to high single digits. And our fund is down more than that, but not much more, which is very interesting to us. The market is beginning to, I think, understand that ARKG is filled with stocks of companies that are going to transform healthcare completely. And we can get into that in a minute. But in terms of overall performance, so ARKK has had a very good year, even though roughly a quarter of it is in the genomic space. And ARKF has had an exceptional year. Now, I will say that our inception was in mid-November of last year. And during those final 6 weeks of the year, it was a terrible market for innovation. In fact, normally we get a Santa Claus rally, and I do hope we get one of those this year. We didn't last year because fixed income was taking all the oxygen out of the room. Long rates last year started falling in mid-October, catching a lot of advisors flat-footed. And so they rushed to re-up their exposure to fixed income. So we didn't get the flush after tax loss selling last year that we expected. We do expect, or we would expect, a better year this year. So excited by what's happening, because what happened this year is, especially through July, the market began to understand, and we believe this is correct, that the Fed was nearing the end of its tightening policy. Now, in the news day to day, you hear the Fed saying, oh no, if we need to, we will tighten. But a lot of indicators out there are telling the Fed that it is done tightening. And we believe that the market began to sniff that out in the first half of the year. And then something happened starting in August, really until just recently. And that is the yield curve started steepening. Now, it was still inverted, but it started to steepen from that inversion through about a few weeks ago. And now the inversion is deepening again. And the inverted yield curve is really one of the biggest warning signals to the Fed that they've gone too far. It's been inverted since July of last year, so more than a year, almost a year and a half. And M2 growth in the United States has been negative on a year-over-year basis since the beginning of the year. And we're beginning to see commodity prices correct. Copper, the commodity with the PhD, is breaking down in here. And so I think the market now, as we're ending the year, is beginning to conclude, after a little bit of debate during the summer months, that the Fed is done and that the next move in terms of Fed policy will be to cut rates. That's certainly what the futures market is now starting to say. So it's a much more friendly environment to long duration assets. Innovation is one of the longest duration in the equity market. And of course, long duration in bonds means what it means, 10-year, 30-year. We should be near the end of those moves as well.
Excellent. Thank you. And then, of course, the big story has been artificial intelligence, such a hot term. And ARK has a great piece on the topic, which we will link in the description below. It's also available on your ark-funds.com website. But can you describe the overall AI exposure across your portfolios, and really what is the opportunity in this space?
Yes, it's very interesting. We've been focused on AI since the inception of ARK, nearly 10 years ago now. And when we put NVIDIA in at $5 a share and really focused investors and advisors on the opportunity, we were looking at it through the lens of autonomous taxi platforms. That's the biggest AI project out there. And so, one of our largest positions is Tesla in the innovation fund, ARKK. Yet, when we first put NVIDIA in, started talking about autonomous and then increasingly AI, really it was a big yawn for investors because it just didn't seem tangible. And then, of course, ChatGPT came out last November, and consumers and investors were able to use it and say, wow, this is miraculous. Now, of course, we know that it's subject to hallucinations, and there's a more realistic view of it now. But AI is provocative and should be provocative. And every company in our portfolios, we have looked at through an AI lens. So you'll notice in ARKK, we sold NVIDIA. Now we rode it from $5 to almost $400, I think. But we were saying, wait a minute, it is very obvious that NVIDIA is the picks and shovels play. in the space. So, it is the hardware play, to be sure. And it has done an amazing job, and all credit to it. Now, there are many companies, though, that are going to harness the AI and are going to drive productivity growth and new products and services to levels that most people do not understand. While they understand NVIDIA, they don't understand some of the AI projects in our portfolio. And the paper that we wrote has to do, well, it's a couple of things. One, most investors, I think, feel comfortable that they have AI covered through the Magnificent Seven. We would disagree with that. We think that in the case of Alphabet or Google, that ChatGPT is either the worst thing that could happen to it or the best thing. It's the worst thing if, as is possible, ChatGPT just automatically goes to the source. We don't have to search anymore. So in that way, it could be very bad. On the other hand, Alphabet probably has the most AI talent and the most sophisticated AI talent in the world. They bought a company called DeepMind from the UK. And that team now, because of the rest of the team's missteps in AI. In other words, they let a chat GPT happen without using the AI tools and doing something for Google specific. They now have had to have DeepMind come in and figure this out. And we'll see if they do. So we think there's a lot of disruption, disintermediation, associated with AI. And we think that with the exception, I would say, of Tesla and Meta platforms, that the rest of the companies could be disintermediated in a way that many do not expect right now. The names in our portfolio are all of them have very deep domain expertise, and especially in the genomics or multiomic space. Domain expertise is essential. It's a very complicated field and getting more complicated by the day. They have to have AI expertise. They need to be taking this AI opportunity very seriously. They need to have good distribution, either alone or in partnership with others. And then most importantly beyond that is they need to have proprietary data that no one else has. And each of our companies fits those 4 criteria. They're not household names. Most people don't know UiPath, which is PATH. It's a robotic process automation company, and it's using all the foundation models from OpenAI and Anthropic and others, Llama, and building on top of them specialized models with data that only it has, data on the business processes that it has been automating for some of the largest companies in the world. Now, that sounds kind of boring, but when it goes to companies and says, we think we can help increase your productivity by 2, 3, 4-fold during the next 5 years, companies that are now facing margin pressure because they're losing pricing power are all over these opportunities. And so their businesses are taking off. Another one is Twilio. Twilio, in all of its products, has a record last year of 12 trillion business consumer interactions. That is data that only Twilio has, and it can help marketing teams target and sales teams target their efforts much more precisely than most other companies can. So names like that aren't household names and that are, from a valuation point of view, so much lower priced than NVIDIA and other very obvious names, which may or may not be helped by their positions in the marketplace.
Yeah, it seems like some of the dangers of AI that have been raised over the past year, they're just seem to be completely blown away and outweighed by the potential opportunities across sectors that the space really has.
And it's true in any new technology. I remember the internet when it came out, many people dismissed it. Oh, it's just for pornography, or it's for gamblers, it's for bad behavior. They just dismissed it. And to the extent they dismissed it, they missed a very big idea.
Now, your research stated that autonomous taxis may have the most impact on GDP of any innovation in history, which is a really bold statement. And this sort of leads me to Tesla, because your team doesn't view Tesla as an auto company, but instead you see them as an AI company with exposure to this megatrend. So explain your thought process around this and talk to us a bit more about Tesla.
Yes, and it is one reason that we got Tesla right, is we put it in the right category. This is not an auto company. Sure, it manufactures autos, but it's a battery company, it's an AI company, it's a software as a service company. And viewing it through that lens and analyzing each of those opportunities, we were able to understand how quickly the costs of electric vehicles would start falling, and therefore how many more people might be attracted to them. And I think many investors now understand that opportunity. We still think that many investors are underestimating how quickly EVs are going to penetrate the auto landscape. We think that by the year 2030, almost all cars will be electric vehicles, not even hybrid, but full electric. We'll have worked out all the kinks in terms of charging and range anxiety and so forth. The opportunity that most investors are not watching carefully, because it seems like such a distant opportunity, is the autonomous taxi opportunity. It's a platform opportunity. And if Tesla gets it right, which it should, unlike cruise automation and Waymo, Tesla has 5 million robots. I have two of them. One is a Model Y, one is a Model 3. 5 million robots out there every day collecting data about the world's roads, especially in the United States. And it is able to use that data to find what are called corner cases. That's where something goes wrong, or something different is happening that may not be happening in the rest of the world. For example, I think Hawaii has blue stop signs. Most stop signs are red. So it had to train its model to identify that if it's blue, it's also a stop sign in this region. But more importantly, where the disengagements are. When is the full self-driving not getting it right? And they're learning by that. Cruise automation, it had to basically stop its autonomous service. Regulators focused on an accident in California. And so it now has to put safety drivers behind the wheel again. Tesla effectively has safety drivers behind the wheel. They're all of us, because we have to keep our hands on the wheels. We think that the autonomous taxi platform opportunity by 2030 will be an $8 to $10 trillion revenue opportunity. That's just a direct revenue opportunity, with half of it roughly going to the platform providers. So sort of $4 to $5 trillion to the Teslas of the world. What's also going to be true at that time is, unlike electric vehicles, whose gross margins are in the 20 to 30% range, autonomous taxi platforms will be like software as a service models. They will have 60, 70, 80% margins plus. And so most people don't understand how profitable the market that Tesla is aiming for will be. They have them categorized as EVs, but really autonomous taxi platforms are, that will be the real category. And Tesla, we think, will be the category killer.
And you talk about how they could even replace airplanes, right? Like for these shorter duration trips. Well, you can save a
Yes.
lot of time by just getting into a car, not having to hang out at an airport.
Absolutely, absolutely. Just think about it from, well, I don't know, from Toronto to Montreal. I don't know how long that ride is, but if it's if it can take place in the office day, your car can be the office for the day as you're moving from one place to the other. If we're talking about going from Boston down to, say, Washington, D.C., it's the same thing. It's a office for the day. And no, you don't have to go to the airport. You don't have to wait. You don't have to be delayed in the winter. So it's going to, we think, threaten 60% of all the regional airlines business out there.
Wild. All right. The next theme I want to touch on is multiomic sequencing because it's an area that really fascinates me. Some of the research is truly miraculous, and there's been a lot of growth in the past 40 years, developments. We're talking about the potential to cure cancer and other diseases that we all want cured tomorrow. But walk us through some of the developments or exciting opportunities you're seeing in this space.
Yes, well, this has been a very exciting year. So we've had human trials in the CRISPR gene editing space in place for roughly 3 years. And the companies in our ARKG, so CRISPR Therapeutics, Intellia, Beam Therapeutics, all of them have shown some measure of success this year. The most number of successes, or the highest number of successes, is CRISPR Therapeutics, and it is in the top 10 of both ARKK and ARKG. It's CRSP is the ticker. It just produced trial results that were so good in sickle cell disease and beta thalassemia that an advisory council has recommended that the FDA approve them. And the dates for this are very soon, December 8th for sickle cell disease, and sometime in March, I believe, next year for beta thalassemia. And just to give you a sense of that, the people who suffer from these terrible diseases, they were incurable, these diseases, before. And they used to have to go into the hospital on an emergency basis 15 to 20 times per year for emergency blood transfusions. And now the ones in these trials, and again, we don't know who they all are. Victoria Gray has put her hand up and said, and she basically told the advisory council her story. She was completely she was incapacitated. She has 4 children, incapacitated, couldn't work, and one gene edit cured her. And now this is 2 to 3 years later. It's a functional cure for those 2 diseases. Another one that Intellia has been involved with is ATTR. CRISPR is also going after heart disease and diabetes. This is a very big idea, and yet these stocks have been punished terribly this year. Why? Because we've got algorithms out there who are focusing on just 2 variables. Are companies making money? And if they are not, if they are burning cash, do they have a big cash cushion? And during the past few years, ARKK's cash runway, it has increased to something like, it's hard for me to believe, so I'll give you the more conservative, but it's somewhere between 6 and 10 years of cash runway for ARKK. And for ARKG, it's somewhere in the 4 to 6 year range. So the order of the day, given how badly the markets have treated these stocks, is, conserve cash, do secondaries, as many did during COVID when their stocks were flying. So we don't think this should be an issue. But algorithms are at work and they really don't care what companies do. It's a great opportunity, much like it was during COVID. During COVID, some of the stocks in ARKG went down 75% in 1 month because algorithms were simply saying cash burn, low cash cushion, out to the woodshed. So my question back then and today was, wait a minute, who do you think is going to solve this problem? Who's going to sequence the genome of the virus? Who's going to use synthetic biology like Twist to develop tests? Who's going to create a vaccine? Our companies. Our companies were going to be the solution. Innovation solves problems. And of course, they were the biggest winners during COVID. The same thing has happened over the last few years. These algorithms are at work again. And I think it set us up for a very big move to the upside, not only in ARKG, but in all of our portfolios, ARKF, ARKK, because innovation does solve problems. And the biggest problem we see going ahead for companies is margin compression, loss of pricing power. And innovation is going to help with the productivity to offset the loss of pricing power.
Another area of focus for you is robotics and 3D printing. And I read a recent article from ARK that Ford anticipates that 3D printing will impact 20% of its general parts inventory. So it'll reduce total inventory costs by 10% or $100 million. How do you see this innovation evolving as we go on, and what's the opportunity set here?
Yes, so 3D printing is part of our autonomous technology, and robotics grouping. And the difficulty with 3D printing in the last year is it too is in a big investment mode. So, many companies not cash flow positive yet. They may have a nice cash cushion, but they haven't done as well, even though we think, again, this is the kind of technology that is going to help companies, especially in the industrial space, aerospace, autos, and so forth, lower their manufacturing costs with lighter parts, smaller parts, and parts configured in a way that the human mind cannot even figure out, because they're helped by the convergence between 3D printing and artificial intelligence. In fact, artificial intelligence is the biggest catalyst to innovation and is going to drive 3D printing and other forms of automation forward now much faster than otherwise would be the case. In the case of genomics, multiomics, what I just described, the convergence between, among DNA sequencing, artificial intelligence, and CRISPR gene editing is going to be the reason we're curing disease. So this is a real convergence movement in the industrial space when it comes to robotics and 3D printing. So we're quite excited by it. One of the things we're seeing is a restructuring in the space because the markets are forcing it. So there are going to be fewer companies to benefit, and some of them will be bought out by big industrial companies like Ford.
Absolutely. All right. To wrap up, I just wanted to touch on the fact that I know we hear a lot of investors are feeling the jitters about the markets and where we're headed right now. A lot of them we're seeing, money flowing into cash ETFs more than ever, or cash alternative ETFs. I just want to get your thoughts around how you actually see your ETFs fitting within a portfolio and what you see as the benefit of ETFs as the vehicle for getting that exposure.
Yes, it's very interesting. If you believe, as we do, that long-term interest rates are in the process of peaking, and they've been in this process for a year. We had the flare up in the summer, but we're coming back to where we were about a year ago. Then if you're in cash now, which is very short duration, you need to think about lengthening the duration and diversifying even more. And I know your advisors at BMO are extremely sensitized to the opportunities being created out there. And so lengthening the duration is turning some of the cash into fixed income. So that's longer duration into long-term fixed income. That's lengthening duration in the fixed income space. And the other side of that would be lengthening the duration in the equity space and getting exposed to portfolios that don't look anything like the big and broad-based benchmarks out there. They're all beginning to look alike. You'll see the Magnificent Seven in a lot of them. In our portfolios, you'll see Tesla. It's one of our largest positions, and it's much larger than in any other index. But you will not see most of the other Magnificent Seven, because we think that our portfolios are going to give you exposure to all of these technologies. So robotics, energy storage, artificial intelligence, blockchain technology, and genomic or multiomics in a differentiated way, differentiated exposure. So as you're lengthening your duration, it would be good, I think, to use a barbell strategy in the equity space. Sure, you have your broad-based benchmarks. They don't cost very much. They're all giving you exposure to Magnificent Seven. And then you'll have our exposures, which based on our original first principles research are giving you exposure to companies that are not in the broad-based benchmarks, but which are going to deliver, we think, more upside surprises associated with AI and other of these innovations and breakthroughs than traditional benchmarks will.
Absolutely. So having it as part of that growth sleeve in your portfolio as the differentiated return stream, right? We talk a lot about building a portfolio and having diversified asset classes in there. Well, this can go into that, yes, it's higher risk, but it is definitely a diversified area of the market. And I think that's, another thing. We talk about all these great stocks, and investors might think, oh, I'll just go out and buy CRISPR Therapeutics because that sounds like it's going to, go to the moon. But really the benefit of that ETF wrapper and having you behind the scenes is that you're building this diversified portfolio for investors with multiple companies that stand to benefit from the eruption in these innovation, in these technologies. And I think that's the huge benefit of the ETF as well.
Right. And if we're right, the opportunity out there, and you'll see this in our convergence paper. It's going to come out sometime in December. The opportunity set out there is going to grow from somewhere in the 10 to 12 trillion dollar range globally in both the public and private equity markets. So right now it's a little more than 10% of those markets. We think that will grow to more than 200 trillion in the next 5 to 10 years, 12-ish trillion to 200 trillion. Those strategies, if that analysis is correct, that's a 40% compound annual rate of return in those technologies. Now, we're not promising that, we can't, but if we're right about the learning curves and the cost declines and how quickly these technologies are going to scale across sectors, that is the goal. And we think that these technologies will dominate the benchmarks out in that time frame. The difference is you'll get in early. And just one last story. The S&P 500 added Tesla when it was roughly $500 billion. We had been in Tesla since it was 10 billion. So it's up, 50-fold since then. How many companies are bigger than 500 billion? Not too many. And that's when they put it in because of their criteria around a 4-quarter moving average of profitability, the last one being profitable. In the world we anticipate, the companies that invest aggressively now and they forego short-term profitability are going to have the best shot at capturing many of these winner take most opportunities. And we think we have them in our portfolios.
Thanks so much, Cathie. You always get the heart beating a little faster. It's very exciting stuff. So I appreciate you taking the time and walking us through the opportunity set here and all your exciting research in the space. So hope to have you back again soon.
Thank you so much, Erin. It's our pleasure and honor. We're really delighted to be partnered with BMO.
Yeah, again, Canadians now have access to ARK's 3 mandates, ARKK, ARKW, and ARKG. Here in Canada, we're the only partner here in Canada. We are offering them in Canadian dollars. Same mandate, same tickers, very similar fees. We talked a lot about the performance at the beginning being strong on a year-to-date basis. These are long-term emerging trends, so keep that in mind when investing. There remains great opportunities across these technologies to gain that long-term growth exposure in your portfolios. Next week, we will be back and we'll be discussing low volatility ETFs, which in fact can be a great complement to some of Cathie's mandates. She talked about that barbell approach. Well, you can have the low volatility equities on one side and ARK on the other side to bring that risk more into a medium frame. But we will have Tony Dong on. He's an author at The Motley Fool and a lot of other different publications, an ETF analyst, and he'll give us some thoughts around the low volatility ETF space. So thanks to our viewers for joining us today, and we will see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.